silver exposure doesn't begin and end with the metal itself. For investors looking for higher upside potential and higher risk, junior silver miners are often where the leverage shows up first. Today, we're breaking down the Amplify Junior Silver Miners ETF, ticker SILJ, and how it provides targeted exposure to smaller silver-focused companies around the world. This is the ETF Investor. Let's dive in. SILJ is designed to track an index of smaller silver companies globally, with a clear emphasis on pure-play silver exposure. Unlike broad mining ETFs that dilute silver exposure with gold or base metals, SILJ actively tilts toward companies whose business models are most closely tied to silver. The ETF includes companies that derive revenue from silver mining, silver exploration, silver development, or silver streaming. These firms are often earlier stage, smaller cap companies, which means they tend to be more sensitive to silver price movements, both on the upside and the downside. What makes a SILJ different is how it determines weights. Each company in the index is assigned a metals-focused sector, such as project development, silver mining, streaming, or diversified mining. Based on this classification, the fund calculates a theme-adjusted free-float market value. In simple terms, the more silver pure a company is, the more influence it can have in the index. After initial weights are assigned, pure-play silver companies are overweighted relative to diversified miners. This is a key distinction. SILJ isn't just holding small miners. It's intentionally emphasizing companies whose performance is most directly tied to silver prices. Once the theme-adjusted weights are set, the portfolio is further adjusted based on market capitalization, with constraints in place to prevent extreme concentration. This helps balance exposure while still maintaining the ETF's silver-first identity. From a maintenance standpoint, the index is reconstituted semi-annually and rebalanced quarterly. That means new companies can be added, others removed, and weights adjusted to reflect changes in market caps and business focus. This keeps the ETF aligned with the evolving junior silver landscape. Now let's talk about how SILJ behaves in a portfolio. Junior silver miners are high beta assets. When silver prices rise, these companies often outperform the metal itself due to operational leverage, expanding margins, and speculative interest. But when silver prices fall, losses can be magnified just as quickly. That means SILJ is not a defensive ETF. It's best viewed as a tactical or satellite position, not a core holding. Investors often use it when they have a strong conviction in rising silver prices or during periods of inflation, currency debasement, or strong industrial demand for silver. There are also company-specific risks to consider. Junior miners face challenges like financing risk, operational setbacks, permitting delays, and geopolitical exposure, especially since many operate outside the United States. Diversification across multiple companies helps, but it doesn't eliminate those risks. It's also worth noting the fund's recent history. Prior to January 29, 2024, the ETF was known as the ETF MG Prime Junior Silver Miners ETF. Then, until May 3, 2024, it tracked a different silver-focused index. While the name and index have changed, the core objective remains the same: concentrated exposure to junior silver companies with a bias toward pure-play silver. The bottom line is this: SILJ is a high-risk, high-reward silver equity ETF. It's designed for investors who understand mining cycles, commodity volatility, and the amplified moves that come with junior miners. If you're bullish on silver and want leverage beyond the metal itself, SILJ offers targeted exposure. Just make sure position sizing reflects the risk. If this breakdown helped, subscribe to the ETF Investor and let me know in the comments whether you prefer silver bullion, senior miners, or junior miners, and why.